Okay, SolarEdge. I got to talk about it. This is not going to be an easy one. Just a few weeks ago, I had done a video saying you should buy the shares, and unfortunately, earnings have come out, and it's down about 23%. So, not the greatest situation. And now we got to figure out what to do from here. So, and it's not easy. First of all, it's not easy to come back on here and say that, hey, that one didn't go well. But remember, I also gave a bonus one in there, and that was infrastructure and energy. That company was kind of a similar, related sort of solar type company, renewable energy and infrastructure type one. And that has some good news. So stay to the end to see that one if you want as well. Okay, back to this SolarEdge SEDG. Boy, this is not easy to understand as well. So not only is it a little bit not the greatest situation to be coming back after the shares are down, but the report is just all over the place, and I rarely see something like this. You can usually figure it out. I don't blame people for being disenfranchised of trying to understand finance and go, I can never understand finance. With reports like this, I can see why you would say that, and I'm having a little bit of trouble myself, but that's the way it is. All right, so let's get to it. First of all, it comes out, adjusted earnings are $1.21 per share, surpassing Zach's consensus of 82 cents a share by 47%. Okay, that's great. Bottom line, moreover, rose 24% from 97 cents a year ago. Okay, and it says adjusted in there, so right away you got to go, oh, okay, what does adjusted mean? And usually adjusted just means there's a one-time thing in there that we're not going to count that, and that's the way it should be. You should not be counting, one-time. I don't know, maybe there was a project and they had to hire some consultants or something, or there was a write-off, or lots of stuff in there that can happen, and you should not. You just want the continuing business. That's the comp. So that makes sense that you use the adjusted. Okay, right? Just hold on to that thought though. And if adjusted is beating by 47%, you expect stock to go up. Now, revenue was a bit of a miss. Now, it's harder to have weird numbers in revenue. Revenue is revenue, right? And it did miss by only 1%. Also, missing, the top line by 1% does not warrant a 23% drop in shares, right? Now, it missed by 1%, but it was also down 17% compared to the previous year. Again, you got to kind of go, well, okay, this is a weird year, right? This is the pandemic, and was it expected, not expected? Well, it missed by 1%, so it was somewhat expected, but not so horrible, right? So we got this missed by 1%, and we've got this massive beat on the bottom line, and shares are down 23%. Really difficult. Okay, it gets weirder. Total profit. Gross profit totaled 108, declining 22% to 139 from 139 the year before. So, gross profit is simply after cost of goods sold, right? Not SG&A and some other expenses kind of below the line of what it costs to produce something, right? So how does your revenue only go down 1% and your gross profit come down 22%? Well, you could just say higher cost of goods sold. That's what that is. But at the same time, I already know they beat by 47%. Further down at the bottom line, like it just doesn't add up. And then they say total expenses rose 6% to $77 million, and then increase can be attributed to higher research and development and G&A, general and administrative. Well, that's not; those are normal expenses. Those are ongoing, normal. That's not one-time stuff. So the revenues basically in line. The gross profit's way down. The SG&A is up, so making the bottom line work. How did they beat on the adjusted? It makes no sense. It just makes no sense. Maybe that's why shares are down. People are going like that. You can't. I don't know. Really, you don't normally see this. Usually, it's like here's the bottom line, and we have to remove something, so the adjusted is this, and it just kind of follows. It makes a lot of sense. This is, it's not adding up. Basically, it's not adding up. It gets weirder. Okay, operating income for the quarter was down 54%. Okay, that's obviously not good. And operating income is usually before one-time stuff as well, right? It's an ongoing operating is normally what it's. No, that's not a GAAP number, so there could be some other stuff in there. Okay. Here's another related number. Cash flow from operating activities were 195 million at the end of the third quarter, up from 175 million. So it's another contradiction. Like, operating income and cash flow from operations are a very similar number, and there's those aren't GAAP numbers, so there are some liberties you can take, let's say, but they shouldn't be like one is down, one is up. It just doesn't work that way. So this is very frustrating. And let's get to the guidance. Even the guidance makes no sense. And they're only talking about revenue guidance. So in the fourth quarter, SolarEdge expects revenues of 345 to 365 million, compared to previous guidance of 325 to 350. So guidance is up on the revenue line. Now that is well below estimates. Estimates are 400 million. It's all over the map. Like, it really is not a consistent report, and maybe we'll have to actually get on the call, because I don't normally have to get on the call. I can just read these things and figure it out. But this is just kind of just bizarre. Okay, so what's the bottom line? Bottom line is sales were lower than the previous year and slightly below estimates. We got to believe that cash flow was worse, even though there's contradictions in what cash flow from operations say all over this report. It's definitely lower than expected. Shares don't drop 23% without the unwinding and people going, wait, unless there's some clarity coming in. Now, I don't think that's the end of the world. It's as frustrating and as annoying as that is. I actually think it's actually a pretty decent company, and I just want to get a little bit of clarity for sure. But down 23, in fact, it might have been down 25% at one point, and it's a pretty decent company. Let's have a quick look in our model. Of course, we don't have this latest quarter, but you'll see the kind of overriding trend. And so look at the white bars in the front here. 5 years of in the teens of return on capital, 18% in the trailing 12. I put a little bit higher going forward because at first I thought, cash flow must be a little bit higher, and I took the growth down. Maybe I should make a little bit of an adjustment there. Bottom line, it's actually reasonably priced now. Another thing that we got to take into perspective, I think is important here, is just the fact that shares are still up even after this terrible day. On a 1 year basis, they're still up 150%. So, when you have a run like that, anything funny in the earnings, any little miss, even a beat, can be a signal to sell, right? So there's a good reason that it sold off. I think it might be exaggerated a little bit, and I also think it's just an opportunity. So that's my bottom line. I'm going with that. That despite all that really tough report to understand, and it wasn't good. Bottom line is it wasn't great, but I don't think it's the end. This is still a pretty good company. Okay, quickly. IEA, Infrastructure and Energy is the name of the company. Sounds like a sector, but it's actually the name of the company. They had a good announcement. They announced a partnership to build a railroad. So, we were actually talking about this as a alternative energy type play, because they do a lot of renewable energy type projects. This is a block and tackle railroad project, but it was a good one for them. Shares are up 19% today. Let's have a quick look at that one on our model, and it's got a short history. And this is an engineering firm too, so it's not, it's not like it's not a product company. It's a people company. So the cash flows are really good. They have levered up the firm. That's a bit of a risk, but they're hitting on all cylinders right now. And I was trying to be conservative in this valuation. Now, I don't want to say, look, it's trading at $8.48. We're saying it's worth $28.48, which is obviously a huge upside. And I don't like to publish that kind of a target necessarily, but I do like to say there's a lot of room for error here. Okay, so that's a long-winded story today on two stocks going the complete opposite way from when we first talked about them. We're sticking with both of them, and we're obviously clearly up on IEA, and we're clearly down on SolarEdge, but sticking with both. Shorter leash on SolarEdge right now.